Welcome to the Deep Dive. We're Talk Tickers, your essential shortcut to understanding the most important earnings calls.
That's right.
Today, we're digging into the second quarter 2025 earnings conference call for Berkley Corporation.
A big one in the P&C space.
Exactly. Our mission for you is simple. Cut through the noise, pull out the really important nuggets, and give you the vital insights you need on this pretty significant report. Let's unpack what Berkley is telling us.
Okay.
So for Q2 2025, Berkley, well, they delivered what looks like a genuinely strong performance.
Yeah, the numbers looked solid.
Their net income per diluted share, it climbed 8.7% over last year, hit $1 per share.
Pretty good job.
And interestingly, they've actually redefined operating earnings this quarter. They're excluding after-tax foreign currency stuff now.
Right, a cleaner number maybe.
And by that new definition, they reported $420 million, or $15 per share. Pretty robust. But what do these numbers, really tell us about the company's health?
Well, what's really compelling, I think, is how that translates into returns, shareholder returns.
Okay.
Based on net income, their annualized return on beginning of year equity, it hit 19.1%. And even stronger, 20% if you use that new operating earnings definition.
Yeah, okay.
And, consistently delivering returns like that, high teens, low 20s, that's really the hallmark of a well-managed insurer.
Especially now, right, in this kind of dynamic environment.
Exactly. It speaks volumes about both their operations and, frankly, smart capital management.
That does paint a strong picture. So how did the core business, the actual underwriting, how did that feed into this? Anything really jump out on the underwriting side?
Oh, absolutely. Underwriting performance was exceptionally strong. They posted a calendar year combined ratio of 91.6%.
91.6. So for folks maybe less familiar, that's good, right? Below 100 is profit.
That's exactly right. A combined ratio measures claims and expenses paid out for every dollar of premium collected. So 91.6% means they're paying out just over 91 cents.
Leaving a nice underwriting profit.
A significant profit margin, yeah. That translated into $261 million of underwriting income.
Okay.
And on top of that, they hit record net premiums earned $3.1 billion and record net premiums written at $3.4 billion.
So growth too, not just profit.
Yeah, showing growth across all lines, really, in both insurance and reinsurance. It's a clear sign the market wants what they're selling.
Okay, so efficient underwriting, impressive growth. Got it. How about the investment side? How did that part of the house do?
Well, supporting that underwriting strength was, frankly, a stellar investment performance. Record net investment income, $379 million.
Another record.
Yeah. And this wasn't just luck. It benefited a lot from the ongoing growth in their assets, fueled by strong cash flow.
Makes sense.
And crucially, the new money rates, what they're getting on new bonds, stayed comfortably above their average book yield.
Ah, that's key.
Yeah, their fixed maturity income, if you exclude Argentina, was up 16.5% year over year. And the book yield, the average rate on their whole bond portfolio ticked up to 4.7%.
So they're putting new money to work at higher rates than the existing portfolio.
Exactly. It suggests they're very effectively putting cash to work, and it bodes well for future investment income.
And, okay, beyond the income statement, what about the balance sheet? Is it looking as solid as the earnings suggest?
Oh, yeah, the balance sheet is rock solid. It really reinforces that picture of financial health, stockholders' equity, up over $380 million. That's 4.3%. It's now at record $9.3 billion.
Impressive.
And they're sitting on over $2 billion in cash and equivalents. That gives them immense flexibility.
Huge cushion.
And their financial leverage, how much debt they use, historically low at 23.4%. Plus, they're clearly committed to shareholder returns. They paid out $224 million in dividends, ordinary and special, just this quarter.
So it really is a comprehensive picture, isn't it? Strength and stability.
Absolutely.
Okay, so those are the numbers undeniably strong. But let's really get into the story management shared. What were they saying about the broader market? What are the big challenges they're facing right now in P&C?
Well, management didn't pull any punches. They highlighted we're living through, quote, interesting moments in the property and casualty space.
Interesting moments. Okay.
Yeah. And they really drilled down on that fundamental challenge, You sell something before you truly know your cost.
The classic insurance dilemma.
Exactly. And that challenge, they noted, is maybe coming into sharper focus now. They're actively grappling with ongoing macro concerns.
Like what specifically?
Things like economic inflation, especially from tariffs, labor market, wage inflation. They attributed some of that to administration policies. Big question marks around national deficits are on their radar too.
Okay, the usual suspects, but clearly top of mind.
And crucially, they're keeping a very close eye on the U.S. consumer. How resilient are they? Because that hits demand everywhere.
Right. It sounds like they're really connecting these big economic trends directly back to their day-to-day. How do these macro factors actually, influence how W.R. Berkley operates?
Precisely. These aren't just abstract economic ideas for them. These factors directly influence, both how they select and price risk that's underwriting and how they position their investment portfolio.
It's a constant balancing act then.
It really is. Between reading today's environment and getting ready for tomorrow's uncertainty, like how will inflation hit future claims costs when you're pricing a policy today? That's the puzzle.
That makes perfect sense. Okay, let's talk underwriting segments. They mentioned the industry is cyclical. Is everything moving together or is it more nuanced?
This is where it gets really interesting, I think. The company emphasized, yes, it's still cyclical, but a big change over the last, say, 5 to 10 years is the decoupling of cycles across different product lines.
Decoupling, so not everything moving in lockstep.
Exactly. Their current accident year combined ratio before sex came in strong at 88.4%, insurance segment at 89%, reinsurance and model-an excess even tighter at 83.8%, so different parts moving at different speeds.
That decoupling is fascinating. And speaking of CCAT losses, catastrophes, they reported $99 million this quarter. That's up from $90 million last year. But interestingly, the impact on the combined ratio stayed flat. How'd they pull that off?
It really comes down to growth in their property book.
Okay.
That growth was significant enough, the premium base got bigger, so it basically absorbed that higher dollar amount of CA losses. It spread the impact.
Shows the benefit of scale.
Exactly. Yeah. Effective scaling, even when loss events tick up.
Okay, let's drill down into some specific markets. Property, what's happening there right now?
The property market specifically is getting noticeably more competitive.
More competitive, why?
Two main reasons they cited. More reinsurance capacity available at lower rates.
So cheaper for insurers to offload risk.
Right. And second, a much more active MGA market.
MGAs again, managing general agents.
Yep. Those specialized agents with underwriting authority.
Right.
And management noted a clear split, a bifurcation. More competition in the big shared layered accounts, less so in the smaller accounts.
Interesting. And the MGA influence, it wasn't just property, right? I think they mentioned a short-term headwind in commercial transportation because of MGAs.
Yes, exactly. In commercial transportation, MGAs are creating that short-term headwind. But management's view is actually kind of interesting. They think this will eventually build pressure and ultimately benefit the responsible long-term players.
How so?
Their thinking seems to be that some of these MGA-driven surges might lack long-term discipline. So when the market eventually shifts or corrects, opportunities will open up for established, disciplined carriers like W.R. Berkley.
Playing the long game there. What about professional liability? Mixed bag there too.
Professional liability, yeah, definitely mixed bag. Public D&O, that's directors and officers liability for public companies, seems to be, quote, finding a sense of bottom.
Which is good news, potentially.
Potentially, yeah, after a lot of volatility.
Yeah.
But private and nonprofit D&O and miscellaneous E&O errors and omissions, those remain highly competitive. And again, largely influenced by all the MGA activity in those spaces.
Okay. And casualty lines, they talked about social inflation. Can you unpack that a bit? And how's it hitting rates?
Sure. Social inflation, it basically refers to claim costs rising faster than general economic inflation.
Mm-hmm.
It's often driven by things like bigger jury awards, courts interpreting liability more broadly, aggressive plaintiff lawyers, that sort of thing.
Got it.
And W.R. Berkley actually sees significant opportunity here to get needed rate increases in primary casualty, umbrella, excess lines because of social inflation.
So it's creating pricing power for them.
In a way, yes. While plaintiff attorneys used to mostly target huge companies, they're seeing that the smaller and middle markets are now also getting stickier rate increases. It signals a broad need for rate across casualty, which is good if you're a disciplined underwriter.
Interesting. Workers' comp, any big news there?
Workers' comp got specific attention too. California approved an 8.7% rate increase. Management highlighted that as a strong firming signal for the whole market.
A benchmark, maybe?
Could be. A powerful signal anyway. But they acknowledged medical trend, the rising cost of medical care for injuries, that's still a persistent challenge they're really focused on managing.
Always something.
Always something. And just quickly, on personal lines, their private client segment, it's a meaningful area for them. Not mass market, very niche, knowledge-driven. and proving to be a strong contributor, both top and bottom line, when market conditions are right.
Okay, so it really sounds like they have a very granular view of each market segment. Let's shift back to investments. Record income there. What's driving that, and what's the outlook?
Yeah, the investment funds did better than expected, delivered $27 million against their $10 to $20 million quarterly range expectation.
What drove the outperformance?
Primarily strong results in transportation infrastructure and financial services sectors within those funds.
Okay.
And their main fixed maturity portfolio, the duration, how sensitive it is to interest rate changes, increased a bit to 2.8 years. That's right in line with their strategy.
And the new money rates?
That's the key point, really. New money rates are coming in around 5.25%. Compare that to their overall book yield of 4.7%, excluding Argentina.
Nice positive spread.
A very positive spread.
Yeah.
It signals really good prospects for future investment income growth. Management said they think their fixed income portfolio is, quote, particularly well positioned.
So they feel good about it.
They do. And they might even extend duration more if the yield curve steepens. Right now, new money is pretty much all going into fixed income because that's where they see the best opportunities. The hurdle for alternatives is pretty high right now.
Very deliberate, very strategic.
Seems that way.
Okay, speaking of deliberate capital use, one thing that caught my ear was why they didn't buy back shares in Q2. Given the strong balance sheet, that seemed a bit surprising. What was the reasoning?
Yeah, that was a really interesting insight into their capital management thinking. Management basically said, look, we had a clear view of our capital surplus, we saw potential opportunities, and we decided the special dividend, that $224 million, was the, quote, most efficient and effective way to return the money to shareholders at that specific time.
Efficiency was key.
Efficiency and effectiveness, given market conditions then. But they were really clear. Share repurchases are still very much a tool they look at daily. It's not off the table at all.
So don't read too much into one quarter's action.
Exactly. And they express strong optimism about future earnings power, suggesting they have multiple ways to return value.
Okay, pragmatic approach. Let's try and connect all these pieces now, the broader investor context. One thing you mentioned was a slight adjustment, a recalibration in their overall growth outlook. What's behind that?
Yeah, that was a key recalibration. They've tempered their overall growth outlook slightly. Used to be 10-15%, now they're guiding to 8-12%.
Why the change?
Primarily due to that property pricing deceleration we talked about. The market's just getting more competitive there.
Okay.
But importantly, they remain really encouraged by the opportunities they see in casualty. They think casualty can pick up some of that slack. So it shows a pragmatic adjustment, maybe prioritizing quality growth over just hitting the highest possible top-line number.
Makes sense. And this brings us back to something we touched on, but I really want to dig into it because management was so candid. The MGA market dynamics. What exactly did they say about this MGA surge, and why is it such a big signal?
This was honestly a moment of real unvarnished insight on the call. Management talked about the extraordinary growth in the MGA space.
Yeah.
But they specifically pointed out that many new entrants, well, they lack deep expertise. And they're often backed by reinsurance capacity that has an, quote, unquenchable thirst for growth without necessarily their finger fully on the pulse.
Wow, strong words.
Very strong. They explicitly said there's often an inherent mismatch or a lack of alignment of interest in many of these delegated authority models.
Okay, that's a fundamental critique.
It is. And here's the kicker, the signal. They've recently seen a significant number of inbound calls from investment bankers looking to sell private equity-backed MGAs.
The exit door.
That's what management suggested. It could be a strong sign that, quote, the music is slowing for this segment. It hints at a potential shakeout, especially for those who chase growth, maybe without enough underwriting discipline.
That MGA insight is powerful, and it ties into another point you raised. They're proactively pricing for future inflation threats, like tariffs or labor costs, even though they aren't seeing a big current impact. What does that defensive stance tell us?
It tells us they're being very prudent, very defensive about potential future loss cost inflation. They're not waiting for these macro pressures to actually bite their bottom line. They're building that risk into their pricing now.
Getting ahead of the curve.
Exactly. It's a proactive way to try and ensure their underwriting margins stay healthy, even if the economy gets tougher.
Sounds like they're definitely playing the long game, which fits with their consistent message about being a liability market. What does that mean exactly, and why is it so central to their strategy?
Yeah, that phrase liability market keeps coming up. It basically means they see the greatest opportunity for profitable growth right now in lines like casualty and professional liability, rather than, say, property.
Focusing their bets.
Pretty much. They explicitly see opportunity over the next 12 to 36 months in liability. That's where they believe the best risk-adjusted returns are in this evolving market cycle. It's where they're leaning in, putting their resources.
Okay, so despite headwinds and competitive shifts, the overall tone sounds confident. What was the final takeaway on earnings stability?
Yeah, the closing remarks really hit that note. They underscored the, quote, stability of the earnings of the business, and they expressed confidence in generating those high teens, low 20s returns for the foreseeable future, regardless of bumps in any single quarter.
Long-term vision.
Definitely. And one last point on their philosophy. Their risk-adjusted return thinking isn't static, it's continuous, daily, monthly, quarterly. They even mentioned how a specific bad malpractice case can immediately make them reevaluate certain lines.
Wow, that granular.
Yeah, it underscores a really dynamic, responsive approach to managing the portfolio, constantly adapting to real-world events.
Okay, fascinating stuff. Before we wrap up, it is time for our This Is Not Financial Advice segment. Remember, purely for discussion, not recommendations. Keeping all that great management commentary in mind, especially the MGA piece and their own strategy. What's a, let's say, outrageous but plausible trade idea that comes to mind?
Okay. Outrageous but plausible. Based on everything, especially that contrast between their discipline and the MGA commentary. How about a disciplined liability long, over-leveraged MGA short pairs trade?
Ooh, okay, I like the sound of that. Break down the long side for us.
So the long side, you'd go long a P&C insurer like W.R. Berkley. Why? Demonstrated discipline in underwriting, smart capital allocation, like that efficient special dividend and that clear long-term focus on the liability market where they see the best runway for the next, say, 1 to 3 years.
Right.
Their ability to grow earnings thoughtfully, even while slightly lowering overall growth guidance, that suggests resilience, quality over quantity. You're basically betting on fundamentals and strategic focus in a tricky market.
Okay, betting on the disciplined player. And then the short side, playing off that MGA commentary.
Exactly. Simultaneously, you'd short a publicly traded, rapidly growing MGA, particularly one that seems heavily reliant on maybe less disciplined reinsurance capacity, or perhaps backed by private equity looking for a faster return. This plays directly into management's insight that the music is slowing for some of these models. The potential misalignment of interests, maybe lack of deep expertise. As management themselves hinted, many of us have seen some version of this movie before. Suggests a potential shakeout for those who prioritize growth above all else.
So the rationale is really to capture that divergence. Management's confidence in their disciplined, liability-focused approach versus their skepticism about the sustainability of some parts of the MGA boom, fueled by that unquenchable thirst for growth they talked about.
Precisely. It's taking their candid market assessment and turning it into a potential trade structure.
Yeah.
A long-short play on market discipline, essentially.
Very interesting. Well, there you have it. A comprehensive deep dive into W.R. Berkley's Q2 2025 earnings.
A lot to unpack there.
Definitely. In a nutshell, strong performance, balanced underwriting and investments, a clear strategic pivot towards liability, and some really nuanced, insightful perspectives on the market, especially that MGA dynamic.
And they remain optimistic about generating those high teens, low 20s returns going forward.
Right. Now, remember, everyone, this discussion, especially that last bit, is purely for informational purposes. It is absolutely not financial advice.
Definitely not.
So what does this all mean for you? As you think about the property and casualty landscape, maybe consider how companies like W.R. Berkley are navigating these shifting currents. How might that music slowing in certain segments, particularly those tied to maybe less disciplined growth, reshape the competitive field in the next few quarters? And what opportunities might that create for players who prioritize those long-term risk-adjusted returns?
Good questions to ponder.
Indeed. We'll catch you next time for another deep dive.